One thing to understand with probability is having good fundamentals. You have then put in a process by which you have said, okay, these are my expectations, this is what happens. So after going through the process, you do right, you do wrong, right? Sometimes you do a proper due diligence and you say it's not worth buying, but you say let me still buy a little bit, and that does well, right? So which means you had very good process, okay, but you still took a decision based on your hunch and it did well. So that also will happen. But largely, if that happens too often, which means you have to check your process. What is it that you are making a mistake, because of which you coming to the wrong conclusion? So you should not worry too much about good outcomes out of bad decisions, or bad outcomes out of good decisions, good processes, right? So you have to work on that, and then you say how the probability will work, and suddenly you find that you are now getting better and better results, which means you have got your process right. So once you get your process right, your results will follow. So one very important thing about probability is, maybe you got everything wrong, but you said, okay, I'll still want to buy this share, so you bought and you bet a lot of money. That is not something which you should be doing, but you did it because one very important thing about the market is not how many calls you got it right and how many calls you got it wrong. The calls which you got it right, how much money did you make? That is what the market looks at. The market is not a probability teacher which gives you marks on getting it right. It gives you money on getting it right, and when you got it right, if you put in a lot more money than what you would have put, then you make more money, right? So for example, Care is a company which I was very bullish on, because based on some research done by, like I said, borrowed research. I was very sure, and then I also talked to people who said, oh, there is going to be a shortage of money in the market, so banks will not be able to support. So again, it means more issuances, more fees for Crisil, Care, etc. And I already had a vested interest in Care, so I bought more of Care. So Care I bought at 530 or 540, then it went down, so I bought more at 420, 430. I just kept buying. Today it is at 650, as I'm recalling, 680 or something like that. So it has done very well. But now the question is, how much money did you put when it was 530, and how much money did you put at 420? If you put equally, then your price is very nicely sitting between 420 and 530. But if you did not have the conviction at 420, which you had at 530, you bought say 5,000 shares, but at 420 you had the guts to buy only 500 shares, then your average cost will be much higher. So it is not just about probability of your earnings and when will you book the profit. So you think it's a great share, it's worth buying even at 650 because it is going to reach a price of 1200. Be my guest, keep buying till you are not fully saturated, and or you start selling, right? So both of them happen. Like for example, Rico Auto, I bought at 27 and 30. I was sure it will reach 100, but it was not reaching 100, so I started selling at 89, 90, right? So it's now about 91, 92. So I've sold a big portion. But I'm still holding on, saying, okay, I think it can reach 100, so I'll sell at 100. So the probability of the company doing well, of you putting money, of you booking profits, all of them are probability. And your success depends on all the probabilities being right and you putting enough money in the one in which you have a lot of confidence. You may end up making more money in one which you have less confidence, but you would have put lesser money. So you may, in absolute terms, make less money in that versus in this, but that's how it works. So later on you get more confidence, saying, okay, if these are the indicators, if this is the promoter, I'm willing to put more money. That is how you keep learning and refining your probability and probabilistic thinking of a company, company fundamentals, expectations, putting money and booking profits. All are probabilities, and you have to work with all those things which are not very sure. So right, so you're working again on probability. Some attributes which we have in our personal life can be very hurtful while investing. For example, you may have lost money in some company in the past for your own mistakes, and you could be blaming the promoter for it and say, oh, I'll never touch that group. You may be right, you may be wrong, because you have to develop your instincts. For example, I do not invest in companies based out of Hyderabad simply because I lost money in some of those companies, right? So there was some United Health Group, there was Nath Pulp, Nath Paper, Nath Finance, and so many of those companies. So it is a bitter lesson, but well learned, in the sense that after that I've been very careful. Maybe I would trade in it, but I would very rarely invest in a Hyderabad-based company. Let me clarify, one company in which I have invested, which is Hyderabad based, on which I am not yet in the money, or I am barely in the money by a rupee or something, is GMR Airport Infra. So it's a recent investment for me, and I hope it makes money. But that is one time where I broke my view that I will not invest in a Hyderabad company. So you have to keep checking what your brain tells you. Your brain likes confirmation bias. It looks for data which is good in line of its thinking. It keeps on telling you, yes, Hyderabad is bad, or things like that, and some of the best companies you might just miss. So don't create an hypothesis and keep it in your head and say this is cast in steel or cast in stone, and I will not make a change in my mind. That is not good. That's a bad habit, right? So what is the probability of success? You have arrived at all that, and then the question is, what are the hypotheses that you have? What are you testing? So test it, see whether it is right, see whether it is wrong. Everybody thought, oh, all you have to do is enter the IT companies and you will make a lot of money. It was true in the late 90s, maybe mid to late 90s, it was true. But 2000 saw the dust, the dot-coms hitting the dust, and then again in 2007 the dot-coms had to take a hit because they had gone up too much, right? So again, fundamentals versus expectation. Fundamentals did not change much, but people's expectation was, oh, these companies are good buy even at a PE of 200 or PE of 300. It didn't make any sense. So those who bought did not get the fundamentals wrong. They were true, they were right about the fundamentals of Wipro in the year 2000 also, but they got the expectations wrong, right? So getting the fundamentals right, getting the expectations right, getting the probability right, and putting enough money, right? A into B into C into D is what makes money for you. You cannot afford to get one of them very, very wrong, because if that happens, then you will lose your money, right? For whatever reasons. Or you may say, oh, let me buy 200 shares. Then it's not going to change the needle in your portfolio. Maybe your portfolio needle is 20,000 shares. So how does 200 shares help you? Just to tell, see, I knew this would happen. If you knew it would happen, then you should have bought more shares, not less, not such a small quantity, right?